What separates professional traders from less experienced traders is that they learn through experience and education to recognize the times when the greatest opportunities present themselves in the financial markets. I'm Seth Freudberg, the head trader of S&B Capital's options trading desk here in Manhattan, and the professional traders on our desk are expert at trading in many different kinds of markets and keenly aware of when unusual opportunities arise. In this video, we're going to show you why so many options income traders quit trading at exactly the worst time to do so, and the opportunities that they're missing by getting scared and crawling into a trading shell when acting calmly and maintaining your disciplines is the far more profitable choice. So if this sounds like something that you've faced in the past yourself, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freudberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos we produce for traders and investors all over the world. They're really very valuable. Okay, so it's no secret that earlier this year the market began to crash in late February as the enormity of the COVID-19 pandemic began to emerge as a massive negative for equity markets as the threat of an elongated worldwide economic shutdown became more and more real. And so generally speaking, when the market crashes, for example, when small cap stocks as measured by the Russell 2000 index crashed along with the rest of the market in late February, then simultaneously the VIX, which as most of you know measures the premium built into options, almost always skyrockets suddenly like this from a relatively low level like 15 where it was before the crash up to a crazy high level like 85 which it reached in mid-March just a few weeks later. Well, in those circumstances, options income traders are going to struggle in most cases, and many of them are going to get stopped out and take their maximum allowable losses. Now, when this happens, and it's going to happen periodically, I guarantee you that, there is a common tendency for options income traders to become scared and depressed, having taken a loss when this kind of a sudden market change takes place. Well, the purpose of this video is to break down for you why this tendency to crawl into a shell after a large loss is precisely the opposite of what you should actually do in those circumstances. So I'd like to run you through a vivid example of this, explaining a very common trading strategy that many options income traders employ using the Russell 2000 index options. Now, before I do that though, we need to make sure that all of you who are watching this video are familiar with how index options work. And so we're going to quickly review the basic concepts and then jump back into the strategy example I wanted to explain. So almost all of you are familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index. Like the Russell 2000 index, you can't really buy or sell 100 shares of the index, but what you can do is get paid in cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the RUT index is trading at 1350 and you buy the 1360 call, if the index closes at 1365, you'd receive $500 in cash in your account. If the index closes at 1360 or lower, on the other hand, your call expires worthless. On the downside of the market, if you buy a 1335 put and the market sells off to 1325, you'd make $1,000. But if the market just sold off to 1335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will also allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Okay, so one of the great things about options income trading is that you can create a very large range of prices over which you can have a winning options trade. And one of the most popular strategies to achieve this kind of large runway is called the Iron Condor. So let's jump into an example of an Iron Condor that you could have entered on February 18th of this year. Now this time you can see that the Russell Index was trading up around 1700, and as we saw before, right before the crash, the VIX was trading around 15. And so let's say that right before the crash, we put on an Iron Condor trade as follows. So with about 2 months to go before the April 17th options expire, the trader buys 10 of the 1800 calls, which will act as upside protection for the trade, and also sells 10 of the 1790 calls. So those 1790 short calls are about 110 points above the market, and you're going to want to remember that. And at the same time, we head down and sell 10 of the 1570 puts, which are 110 points below the market, and also buy 10 of the 1560 puts for downside protection on the trade. And once we complete all of those transactions, which incidentally can be accomplished with a single order, it's known as a complex order. Once all 4 of these options positions are entered into, that formation is known as an Iron Condor. Now, before we get into how this trade plays out as this pandemic crash hits, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open a free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. Getting back to our Iron Condor trade, let's first examine what has happened here from a cash flow standpoint. Look first at the short options we've sold, and we've sold 10 of those 1790 calls for $355. And remember, each call represents $100 per point above 1790 on expiration in day. And so we multiply the $355 price times 100, and we sold 10. So you multiply that by 10 to get the total cash flow from the short calls of $35.50. And you can see with the 1305 price on the 10 short puts, we collected $13,050 for those. Then in turn, we paid $2,700 and $11,850 for the 10 calls at $1,800 that we bought for upside protection, and the 10 1560 puts we bought for downside protection, respectively. And so when you net it all down, we received initially $2,050 of cash inflow from entering into this Iron Condor trade. Now, so what is the premise of this trade? Well, it's pretty simple, and that is if the market closes anywhere between 1570 and 1790 on the day that all these options expire in April, then all 4 of them will expire worthless. However, what if the rut doesn't stay nicely within those 2 ranges, but falls outside of those ranges? What happens then? Well, typically, Iron Condor trades will have a stop built into the trade, and a very common way to calculate your stop on an Iron Condor trade is by closing the trade when the trade loss has exceeded 150% of the cash flow on the trade, which in this case is $2,050. And so multiplying that by 150%, we get a maximum loss on the trade of $3,075. Okay, so let's now move forward to February 27th. And as you can see, the COVID-19 crash has begun and the RUT index loses over 11% of its value in 9 days. So if we analyze the position we're in on February 27th, you'll realize that we have hit our maximum loss, and because the market's so volatile, we've actually exceeded it a bit, and so we're stopped out of the trade and we have to exit. So let's see exactly why we're stopped out of the trade a little more than a week after we initiated what was supposed to be a 2-month trade. Whenever you're in an options trade, your broker will constantly be calculating the value of each of your long and short options during the course of the trade. And so at that moment on February 27th, when we got stopped out of the trade, we can look at the value of each component of our position. So the way to evaluate your position is to ask yourself, if I had to close this position right now, what would I need to do? Well, to close short options, you have to buy them back at the market price that the market is charging for that option at that moment. And similarly, for long options, you can sell them for the price the market's offering for those at the moment. And so if we analyze the value of each option in the Iron Condor, you can see that the price of the 1790 short calls have dropped to 65 cents because the market has sold off so much that the market's not assigning much of value at all to that call having any value at all on April 17th because it's way up there at 1790 and the market's down at 1507. So to close that short call, we'd only have to pay 65 cents. So you can see from the calculation the total cost of closing those 10 short calls, buying those back in other words, would be $650. Now, the short puts at 1570, well, those have blown up in value because the market is 63 points below those short puts, and to buy those back, we'll have to spend a huge amount, $93,550. The 1800 calls up top, well, those have also lost tons of value. So when we go to sell them, we're only going to get $550 for them. But now look at the 1560 puts we bought for protection. Well, those are now massively valuable, and we can sell those for $88,000. And so if you net it all down, the cost to close the trade comes to $5,600. But remember, we initially collected cash of $2,050 on the trade, and so you back that out from the cost for a final net loss of $3,550. Now, when the market crashes, as I mentioned, these trades are typically going to get stopped because the whole theory of the trade is that it's going to make money if it stays inside of that original range of 110 points above and below the value of the RUT index when the trade starts. So at that point, an amateur trader might say, hey, I just had a big loss. This market's too dangerous. I better quit trading. But a professional trader thinks more deeply than that and realizes this is actually a wonderful market opportunity, and you'll see why in a minute. So let's move forward now to mid-March when the pandemic crash had worsened substantially. Now let's replicate the same trade that we just looked at, a 2-month Iron Condor trade that we'll initiate on March 16th, except that this time we'll make the profit zone of the trade run 200 points to both the upside and the downside. So whereas the previous trade had a 220-point zone within which all the options would have expired worthless and your initial credit could become your profit, in this case, the zone of profitability has increased to 400 points, almost twice as wide. What's more, as you can see from the calculation, based on what we received for the short options and what we paid for the long options, we received $4,850 for the trade, way more than twice what we received before on the trade that we initiated right before the crash. And so we're 180 points wider and more than double the income potential on the trade. Now, this is no mistake. As the crash occurs, the market volatility drove the prices of the options way up, and so even options much farther from the market price of the RUT yielded more potential profit. So now let's move forward to the day that this Iron Condor expired on May 15th, and you'll see that the RUT index expired at 1231.70, which is well above the location of the puts and well below the location of the calls, and therefore, because the calls only have value if the index opens above their strike prices on expiration day, and the puts only have value if the index opens below their strike price on expiration day, then all 4 options expire worthless. So that means that the original $4,850 credit that we received for initiating the Iron Condor trade is pure profit to us. And more importantly, because we didn't quit our Iron Condor strategy campaign, but instead persisted with this strategy after the big loss from the previous month, we ended up making a far larger profit than the loss we suffered the previous month, resulting in a 2-month profit of $1,300 versus a 1-month loss of $3,550. And so there are really 2 very important lessons that I'd like you to come away with from today's video. And the first one is that often in options income trading, the month after your biggest loss of the year becomes the month where you can have the largest win of the year. And we saw that happen in this case. And the reason for that is that in a crash, options pricing gets so much more extreme that there's much more profit to be made once the market has adjusted to the new crash conditions and is charging appropriate pricing to a crash situation. But even more deeply, the truly most important lesson of this video is that losing in any form of trading is completely normal. and in fact guaranteed if you've traded for any length of time. And so to abandon your strategy after one loss is a formula for failure. Whereas persistence in maintaining a solid strategy, regardless of any 1 month outcome, is the way that the great traders succeed long term. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That opens the free registration page in a new window so you don't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.